Hey guys, Reagan Doherty here. Hope you're doing well. I'm here with the Doherty Real Estate Group. I work with my dad, Devin Doherty, who a lot of you know as well. And we are coming at you May 16th, 2023, with a real estate market update. It's been a crazy past few years. I've been really blessed to be working with my dad in the business since I was a little kid and full time the past few years and learning all about this crazy market that we've been in. So there's a lot of hearsay and a lot of gossip. The market's going to crash. We're going to have the world's biggest crash, Great Recession round two. And that's what it's exactly hearsay. That's what it is. We've had a lot of people wanting the market's going to crash, hoping that it's going to crash, and we've just not been seeing it. What we are seeing, though, is a housing affordability issue. That has been a major issue in the market here is housing affordability. And what is housing affordability? It is when you can't afford a house. Interest rates are too high, your monthly payments are too high, and that is because our active listing inventory has plunged 41% since October 27th. There's not a lot of properties on the market, which is causing people to fight for the little properties that there are. Now, what's happening to inventory is a question a lot of people are asking. We're at some of our lowest inventory since 2004. Now, the reason we're not going to see the market crash is because in the Great Recession, if you see here in our slides, back in 2011, 2012, we had a lot higher of inventory. Therefore, there was a lot more of a crash, right? So with our higher inventory, we saw a bigger crash. The 5-year average peak from 2015 to 2019 was about 7,000 homes. Currently, there's only 2,000 homes or so on the market in Southern California. Our inventory is significantly down where we wouldn't see a crash until our inventory would hit a spike. Year over year, we're down 6% in our inventory. The 3-year average, when we say the 3-year average, we're referring to that, 2017 to 2019, that window of a normal market. That normal market was 109% higher than where we currently are, which again means we have such little homes on the market. It's causing a fight. Even with a low demand, we're still seeing values stay really strong. Now, these are the mortgage rate projections by Fannie Mae for the upcoming year. This year we started off about 6.4%. We're hoping by the end of the year to get to 5.7. The rates were raised last year up to 7.37% in order to help with inflation. But what we've really seen is the market was really stagnant and still is because nobody wants to move. Over 80% of Californians have a rate 4.5% and below. Why would they bump up to a 6.4% rate? That's where the affordability comes into question. And as I'm sure you all know, when mortgage rates go down, demand goes up, values go up, etc. Now, this is a really cool graph I like about affordability, how rates impact affordability. If you take a look here at the purchase price of 1.25 million, people shopping, last year, beginning of last year, 2021, we're looking at a monthly payment amount of $5,067. Now, if somebody wants that same monthly payment amount, they got to bump down to $1 million. They lost $250,000 in purchasing power. All of my buyers, when we shop now, because of the volatility of rates and where they're at, first thing we look at is what would my monthly payments be on this property. And again, it changes every day based on the situation, but monthly payments really drive affordability. That's why we've not seen people move. Why would you bump up your rate? Why would you go, lower your home value? This is another one that I really enjoy looking at. This is a $4,000 desired monthly payment. As you can see, a 3.2.5 rate with a $4,000 monthly payment, you're buying close to 1.2 million. Now, if you're looking at 6.5, you're buying closer to 800,000. So people just have lost a lot of buying power. Now, what a lot of my clients are doing is they're buying now, regardless of the rates, in hopes to refinance down the line so that they can buy before prices skyrocket any higher. Now, again, this is our rates. We were down in 2021 at 3.25%. Would have loved to get myself a home at that rate. Now we hit a peak at 7.37%, and we're down in the mid sixes currently, hoping to get back to the fives by the end of the year. Now, this is the Orange County Housing Affordability Index provided by the California Association of Realtors. If you can see here, we're in the teens of how many people can afford the median priced home in the market. We're below 15%. Back in the Great Recession, close to 40% of people could afford the price of homes. Now we're in the teens, which is significantly lower than where we'd like to be. This is the LA County affordability over time. If you look at the bottom here in 2023, 52% of your income goes towards your monthly payment on a median detached sales price property with interest rates of 6.49%. Back during COVID time, interest rates around 3%, about 37 to 42% of your monthly income was going towards your payment. If you take a look at Orange County, it's even crazier. Over 70% of your monthly income goes towards your monthly payment on a medium detached sales price property at 6.5% rates. So affordability is an issue, but it's not as big of an issue as our supply. Now, take a look at demand here. Demand here, each of these peaks in general on this slide are our spring months. So March, April, May, that's generally when our demand is highest. That's when our inventory is highest. If you take a look at our spring months here on the right where the arrow is pointing, our demand is significantly lower. It is significantly lower. And this is not only because of affordability, but it's because of our lack of inventory. This is based on our pending sales. We would have much higher pending sales had we had more inventory this year. Now, moving on to the next, we're down pending sales 33%. And our demand is, again, significantly lower than it was. It's pre-COVID, our demand was 52% higher than it is today. And that's based on affordability and based on the low supply we're currently having. Our active listing inventory, as you can see, we kind of hit a peak, if you will, in this market last year, back in 2022, right when rates were coming up. People were not really sure what to do. So people were listing their homes and getting rid of them before the crash, so to say. Now our inventory has significantly dropped, like I've been mentioning. We are at a really low point here. Now, last year we had 5% more inventory than we currently do. A lot of people have this in their heads that last year there was, we're having more houses this year than last year, but that's not exactly true. We still are dealing with this affordability crisis and this lack of inventory, which is really driving the market. Now, new listings per month. This is mind-blowing. We need more listings in the market. That will bring more stability, if you will, to the market. We are down 42% year over year from our 2017 to 2019, the normal times, monthly average. That's how many sellers we're missing this year. Normally, I've had a lot of my clients say, Reagan, more homes are going to come on the market in, March, April, May, June. I hope so. I would wish. But here we are. We're still down 42% of sellers. Now, these are our projections for the rest of 2023. We're hoping to see it continue to increase in May and a little bit of June. Then we're going to see it decrease, as it always does, through the end of the year. And we're missing this year over 114,000 sellers, which again makes it difficult for our buyers. They're fighting for what little inventory they have, and it's feeling very much like a seller's market. Now, low supply and affordability are the biggest tug of war we're facing here, and a lot of people think affordability would win, but low supply is winning. It's causing us to see this increase in prices. Just over the past couple weeks alone, we've sold properties in 2 days, in a day, 50,000 above asking, and which is super, super crazy to believe. But our buyers who are buying those properties are looking to refinance before prices continue to increase as rates, like I showed you in the beginning, come down towards the end of the year. Then the demand increases, prices increase, and so on. So we're fighting for crumbs here. We're fighting for the crumbs of properties, which is why buyers need good representation to get into properties. Again, most properties I've been working on are selling with multiple offers over asking. So you need to have good connections with the communities. You need to have good representation. You need to have a strong offer, strong lender, cash, whatever you're going with, to be able to close quickly, effectively, and to win the deal. Now, last thing I want to show you is the speed of the market. Currently, this is all of Southern California, so take a look at this depending on where you're at. Our current actives are very fluctuating, and again, way lower year over year. Our market time is staying pretty stable over the past couple months. It's longer than last year, yet still very, very quick. Any market time below 50 days is considered a hot seller's market, an insane seller's market, if you will. So this is our current market time in California, Southern California. 46 days is average. Last year, 37 days. A normal market prior to COVID was 65 days. Orange County, in certain cities, we're looking at 10 to 12 days, and the good ones priced at the fair market value are selling in just a few days. It's a really crazy market we're living in. We need more inventory is what it comes down to. More inventory will help with the solution, and interest rates will help as well. So what we're looking for is sellers who are needing to sell, to relocate, looking to refinance, and buyers who want to get in the market and hope to refinance down the line. It's a crazy market. We are all looking to make the best of it. I have been working full time with my dad for the past few years, and I've only experienced the crazy market. So we have lots and lots of strategies to help our buyers win, to help our sellers make the best decision. And what we're all about here is helping people build their generational wealth through real estate and help them on their journeys. So, whatever that looks like for you, whether it's moving or staying put or renting out your property, staying in state, moving out of state, we're really blessed to have teams all over the country and help lots of our clients make the move to where they need to get to, whatever that looks like, whenever that looks like. So feel free to give us a call or a text back at 949-629-4400. For any questions at all, we are happy to help support you the best we can. Have a great rest of your day. Bye.